Hello, welcome to the Economic View today. I'm joined as always by our Chief Market Strategist, Evan Lucas. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Look, Evan, I wanted to talk about the US-China trade war. It's escalated. It went quiet for a while. Then on Friday, the US came out with announcements announcing some more tariffs. We're expecting that. China retaliated pretty much straight away, announcing similar. Then they've gone on the attack, of course, against the US, accusing the US of being arrogant, rude in this whole sort of trade war. Now the US has launched another salvo, potentially adding even more tariffs against Chinese goods. It's just going from bad to worse.
It is, and I think it's not just going from bad to worse, it's the ratcheting up of escalation. So if you go back to what you alluded to on Friday, so the $50 billion of tariffs that the US looks like putting on top of the original tariffs that are put in place would be 25%. It is quite broad-based. It is across basically the spectrum. They are trying to target China's anti-competitive IP issues, and that we know about that. What's more interesting from my perspective is that the last 4 or 5 months, he said, has been quiet. The USTR, so the US Trade Representative Group, all of that work that they've done over the last sort of 4 months has been scrapped. So that was smoothing over relations with China, looking to actually see them open up their auto industry. And China had been saying very publicly that they were going to do that. Gone. They've also scrapped their plans about negotiating with the US about opening up legislation to allow US exports into China, more regulation. All over on what happened on Friday. China responded, as you said, on Monday morning, and their setup will be a $34 billion initial on the July 6th, barring that nothing changes with regards to the Washington issues that are going on, and then a further $16 billion in around about the 16th. The difference between what the US has done and what China is doing, China is clearly very targeted about what they are pointing at. It is things like soybeans, it's things like wheat, whiskey, the US auto industry, and also the aeronautical industry, very much targeting Midwest and very much core Trump areas. What's happened this morning and why it's got even further is that there has been a communique from the White House for immediate release for the USTR to find an additional $200 billion US dollars. Now, China only has a trade export with the US of around about 126 billion. So they're now being trumped, excuse the pun, on the back of what could come into this. But this is an absolute escalation on the back of it. And I want to show a couple of things on screen right now. This is the initial reactions from the Aussie dollar against the yen and against the US dollar off the back of those. And you can see dramatic fall away. And we've seen risk off all the way through Tuesday. So US futures markets were down. The Chinese markets coming back from a public holiday, by the way, but they were down in Hong Kong, Shanghai, and also in Tokyo. Shows you that this is different from what we originally saw back in March, is that this is actually now tit for tat. The Chinese have sort of been forced into this, and they're going just as hard as the US.
Yeah, Evan, I mean, it's really ratcheting up, as you say. And the other thing is that, when the trade war first broke out, so to speak, we were all worried about what the escalation would do in terms of other countries. And of course, we've seen major ramifications, in Europe and other countries, including Australia. This time round, the same thing. I've seen, a number of countries expressing concern about what these latest trade tariffs are going to mean for them. Because really, I mean, we're in a global economy, everything is interlinked. And of course, whatever is happening in China directly impacts Australia and
it's
a
growth
countries.
issue, isn't it? So it's the issue here is that the impact on the global growth story is clear. We can already see that this tactic from the White House to negotiate a better trade deal, as they call it, is affecting global output. It's affecting global trade. And you can see, as you alluded to, in Europe last week's their PMI data was down, but you look at the export issues they had, is that they are starting to see slowdowns of exports to the US. The other interesting thing about what's happened this week and talking around that whole global trade idea is that President Trump's biggest sort of pitch to hit the domestic market is the trade imbalances, as he calls them. And the interesting thing that came out this week is that China, by a long way, is an absolute country mile ahead. So I'm not sort of suggesting any otherwise in terms of that differential. But the next three are very interesting. The next largest trade deficit the US has with is the European Union, then it's Mexico, then it's Japan. That in itself is quite astounding. And the European Union is big enough to start making him stand up and say, well, I'm getting a bad deal with China. It probably explains why he's now talking about and has started to implement the aluminium and steel tariffs of 25 and 10% across the EU. He's already talking about Mexico as well. The one that would be really interesting is if he did the same thing against Japan, because that would be a clear escalation against one of the absolute core allies of the US. Would be to put a penalty on their largest one of their largest trading partners and one of their largest allies defensively and economically. So keep an eye on that. That is his other core metric, is around economic imbalances or trade imbalances as he calls it. And those four nations are the ones that he's clearly targeting.
Well, there's clearly a long way to go on this, Evan, and much more to come. We'll keep an eye on it and keep you in the loop on the economic view. Thanks for joining us.